U.S. government debt has been downgraded by Fitch from AAA to AA+. While this is not completely unexpected, given that the federal deficit and debt levels are out of control, I do think it basically highlights that there is a significant problem that should be focused on. Credit risk to the U.S. government is actually probably pretty small, and AA+ is still a very high ranking. The real issue with U.S. government debt is interest rate and inflation risk, both of which are probably going to raise their ugly head at some point here over the next decade. The reason for that is that the U.S. deficit and spending levels continue to grow, and they continue to compound at ever higher rates and continue to pile upon the debt levels. At some point, this will create higher interest rates and higher inflation, in my opinion. The Congressional Budget Office, the CBO, is the chart I have behind me. So this is their forecast. And even the CBO, which is probably too optimistic, is expecting a $1.4 trillion debt this year. They're expecting that, deficit this year. They're expecting that deficit to grow to $2.7 trillion by 2033. These numbers are probably optimistic. Currently, Fitch is expecting the deficit this year to run at about $1.6 trillion. So you can see the CBO is probably a little too optimistic in their forecast, both on the near term and the longer term. Even on the optimistic forecast by the CBO, we get to a $46.5 trillion debt outstanding by 2033. So those are just staggering numbers, especially compared to the size of the economy, which is in the $26 trillion neighborhood currently. The revenues coming into the U.S. government are around $4.8 trillion, and the expenditures are over $6.2 trillion this year. These problems have been going on for decades. First, you had the financial crisis, which ended up being a big expenditure. The debt levels increased dramatically. And then you had COVID, which also ended up having major deficits as the economy basically was shut down and stimulus checks were sent out to keep the economy rolling a little bit. Those were both financed largely by the Federal Reserve, which managed to increase its balance sheet from $800 billion in 2007 to $8.9 trillion, an 11-fold increase by 2022. They've started reducing it now over the past year, and it is back down to the $8.2 trillion level. And they're expecting to decrease it by about $1 trillion a year. So the Fed is now a net seller of U.S. government bonds. In addition to that, other central banks around the world have been reducing their U.S. government bond exposure and also increasing their gold exposure as an offset. So this means that there's really not a lot of buyers out there for bonds. As this issuance continues to escalate and the tsunami of debt comes to the market, so basically you're stuck with private pensions, insurance companies, individuals buying this U.S. government debt, and the real question is, will they demand a higher rate? Since they're not artificial like the central banks and the Fed, will they demand a reasonable interest rate for to make these purchases? So there's a very real possibility that they do demand a higher rate, especially given that the budget deficits and debt don't seem to be able to be fixed. We had multiple things: COVID, the financial crisis, 2 wars that were very expensive, each costing trillions of dollars, and we've had a situation where Social Security and Medicare payments have dramatically increased as the baby boomers went from paying in to getting receipts and getting benefits of Social Security and Medicare. So that's been a huge swing. If you go back to the 1990s when all the baby boomers were basically working and paying taxes, Social Security taxes, Medicare taxes, the federal government actually ran a balanced budget there for a very brief period during the 1990s boom. But no longer. Those are now two big negatives on the spending side, and they're forecasted to continue to increase at above GDP rates of growth. So that's going to continue to drive the deficit higher over time. The other aspect is, the Fed was depressing interest rates here over the past 15 years and has started to reverse that course. Short-term rates have risen to 5%. And so the interest expense that the Fed is paying out, the rate has gone up at the same time that the debt levels have gone up. So we're now approaching a $1 trillion a year annual interest rate payment by the federal government. So this actually compounds the deficit problem and compounds the increases of debt, which ends up compounding the interest payments that have to be made every year, and that compounding effect is building upon itself. So in my opinion, the $47 trillion debt level that the CBO is forecasting for 2033 is in all likelihood going to be considerably low. So we're in a situation where the debt's heading up and deficit can't be fixed. Central banks are reluctant or been selling bonds. The Fed's been selling bonds. So private enterprises need to be the buyers. And so the real question is, what rate will they demand to actually participate in buying federal government bonds when they see the debt and deficit continuing to accelerate? The other question is, what will happen to businesses in need of capital as they have to compete with these ever-increasing debt levels? Will the federal government debt issue force out private enterprise so that there's less capital available for private enterprise to invest in growing their business, opening new plants, expansion plans? What will happen there? So will that slow the economy down? If the economy slows down, that means tax receipts go down. And if tax receipts go down, the deficit level goes up. So the tsunami of U.S. government debt could create a significant problem with the squeezing out of private enterprise. Will the Fed pivot? The real question, in my opinion, is not will the Fed pivot. The Fed is going to be forced to pivot as rates get to a certain level because the compounding impact on the federal deficit is going to get out of control, and they'll come in and start controlling rates again and buying bonds and pushing down the interest rate. The real question is, when will they pivot? What will happen to financial markets when the Fed does pivot? Will the financial markets look at the monetization of the debt and say, wow, inflation is really going to be high here. We need to avoid longer term based assets. Will there be a significant hit in high PE stocks, the growth stocks? What will happen when that occurs? Will that occur? What will happen to the bond market as the Fed comes in and starts to monetize? So will the other players in the bond market say, wow, we're basically losing money on a real basis if we're buying bonds, so we don't want to be buying bonds? Could that be a significant issue going forward, that they don't want to accept a negative real rate of return on their long-term bonds? So more and more of the bonds have to be held by the Fed, and the private sector does not want to participate. And the other question is, how high will inflation go when the Fed starts to monetize? We did see that we had a big uptick in inflation as the Fed basically doubled its balance sheet during COVID, and interest rates, inflation and thus interest rates both took off during that time frame. So these are a few questions that I have that I really don't have good answers for you. I do think that they are questions that will, over the course of time, we'll see what happens. The timing of the Fed pivot is impossible to forecast. And I think it does warrant that you need to be cautious until the Fed pivots. That caution would mean, owning less stocks than normal and also owning more cash, especially with cash paying you around 5% right now. Cash or money markets, pay you a reasonable rate of return, so that's a reasonable place to have some money. I would avoid the longer term part of the bond market. The risk of inflation and higher interest rate risk means that bond prices, either on a real basis, will have a negative return, or possibly even on a nominal basis could have a negative return. If you look back at what happened in the 70s when inflation was raging, the bond prices dropped dramatically during that time frame, and that could happen again. So I would avoid the long end of the bond market. The items that I do think make sense here would be gold and gold stocks. The central banks around the globe are buying more gold. They're selling U.S. Treasuries. I advise you that to do the same thing, or at least I'm doing that for my portfolio. You should consider doing that for yours. So there's a lot of moving parts. I do think staying cautious is still warranted. This is what I'm doing for my own portfolio. As you know, this is not personal investment advice, but only what I'm doing for my own portfolio. Please take a look at our full disclaimer on buildingbenjamins.com, where you can also sign up for text and email alerts so you'll get this information on a timely basis. Thank you very much and have a great day.